All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world, and happy Thursday, everybody. Today's August 8th, 2024. The top story this morning, the market is breathing something of a sigh of relief. Emphasis something, because it's not exactly good news that we just got. Initial and continuing jobless claims just came out a few minutes ago. It was something of a mixed bag, but it wasn't a disaster. And I think that's why the market initially reacted pretty positively to it. A lot of market participants, they're hyper-focused on unemployment right now, that big R word, the recession, especially in the wake of last Friday's jobs report, which was a freaking disaster any way you look at it. And then, of course, the ensuing panic that spread over to Japan, causing the unwind of the carry trade, which came right back here. Dogs and cats living together. We all lived through Monday. We all saw what happened. Well, the data we got today, it wasn't good, but it wasn't a disaster. And I think the market is interpreting that as good news. So let's talk a little bit about it. Initial claims came in at 233,000. That is versus expectations of 240,000. So that's a good number. All right. Fewer initial jobless claims than feared. That's also way down from 250,000 last week. Although I would add that 250,000 initial claims from last week was ever so slightly revised up from 249. So initial claims, I'm going to go ahead and say initial claims was a good number, all right? 233,000. A few months ago, that would have been considered high, but in the context of last week, there's a little bit of relief there. That little uptick in the revision to last week's number, I think we can gloss over that. Lower initial jobless claims, that's going to be interpreted as good news. Now, continuing claims wasn't really good news. It was bad news, but it wasn't terrible news. All right. And then I know I'm being very wishy-washy here, but I've looked at these numbers and I'm trying to be like, is this good? Is this bad? It's just kind of meh. That's really all it is. So continuing claims, 1,875,000 or 1.875 million. All right. That's versus expectations of 1.870 million. Or 1,870,000. So continuing claims was higher than expected. And that's showing that people are losing their jobs and they're having a harder time finding new jobs. And so we're still accumulating folks in the continuing jobless claims category. The ranks of the unemployment continues to rise. However, it's also worth pointing out that's up from 1,869,000 last week. So again, continuing to rise, continuing claims, continuing to rise. The unemployment rolls are swelling, but that number from last week, that 1,869,000, that was revised down from 1,877,000. So there was a pretty big downward revision to last week's pretty catastrophic continuing claims number. So if you look at it from the standpoint of where we were yesterday before this number came out, we were at 1,877. Now we're at 1,875. Well, in the context of the downward revision, the continuing claims number was actually good. So it really depends how you want to look at this, guys. You're staring straight ahead at the gauge. This says, it's just kind of a jobs report. But if you move your head this way, it looks like the jobs report was good. If you move your head this way, you can make the report look bad. So I think in a lot of the commentary that you see today, if you go to some other sources, I think you're going to see people's political bias showing. There will be some that are eager to say this shows the jobs market is strong and it's not as bad as the people were fearing. And then other people who are tilting the other way when they look at the gauge are going to say this shows that everything is still catastrophic. It doesn't do either of those things. This data was just kind of meh. All right. And there was good, there was bad. I think overall, considering how much the market was afraid of a disaster, I'm going to go ahead and say this was a good continuing and initial jobless claims just because of the absence of disaster. Does that make sense? Are you guys following me? Also, one thing that was a disaster that didn't get as much coverage as I think it deserved is that 10-year Treasury bond auction that was yesterday. The government auctioned off $42 billion of 10-year Treasury bonds, and it was a lousy auction. The tail on that auction was 3 basis points. Now, the tail, if you guys don't follow bond auctions, which I don't follow them that closely either, You have what the average bid is heading into the auction, and then once the auction begins, the government has to lower the price until enough bidders show up to buy everything that they're selling. And they had to lower the price so much yesterday that the interest rate, the highest interest rate received, was actually more than 3 basis points higher than heading into the auction. Now, that is a huge tail. The average of the last few auctions has been something like 0.1 basis points. So this was a very big Treasury auction tail. That shows that there's reduced appetite for U.S. government bonds. Now, why do we care about this? Think about where we were on Monday. There was a flight to safety. There was panic going on. Everything was selling off, and the market was buying into the bond market. They were buying the 10-year hand over fist. That's why we got that big red candle on the 10-year yield chart. And then for the last 3 days, pretty much since like 10 a.m. Monday morning, that has reversed. And we've seen the yields creep back up, which means people have been selling the bonds. And then we got that disastrous auction in the 10-year yesterday. So there's a lot of like whiplash going on in the bond market here. Bond traders can't really make up their mind where they want to go. The 10-year yield is now almost back to where it was Friday before we got that disastrous jobs report. So I don't really know what to take away from that bond auction. Some other things, by the way, bid to cover was 2.32. That's down from an average of 2.53. Again, that's suggesting that there is less appetite for these bonds. Primary dealers took home 17.9% versus an average of 12%, again, indicating lower appetite, lower demand for these 10-year Treasury bonds. So maybe this has something to do with the Bank of Japan and that weak sauce that came out of them yesterday. Remember, we were talking on our stream yesterday how the Bank of Japan said, oh, so sorry, everybody, our fault. We caused a little bit of volatility with our itsy-bitsy little 15 basis point rate hike. Don't worry, we won't do it again. Please stop selling our stocks. Maybe the market is interpreting that as these central banks are still so freaking weak that they are going to zerp and burr the second things get difficult, like they've always done. And therefore, they're probably going to try to inflate their way out of this next crisis that's coming. And if they're going to do that, I sure as hell don't want to lock up my money for 10 years, not for 3.6% interest. And so the bond traders are less apt to lock up their money for 10 years. They're demanding a higher interest rate. It's possible you're starting to see a slight increase in long-term inflation expectations because the central banks are showing us how spineless they really are. Also going on this morning, we got some earnings reports. We had Restaurant Brands. It's a parent company of Burger King and Popeye's Chicken, a couple of other brands like that. It was slightly better than expected, not disastrous, but still we're seeing weakened consumers, less spending at restaurants. Although we did see some same-store sales growth from some of their chains. So not as bad as some of the restaurant data we got yesterday. We also got results from Under Armour this morning that were terrible results. The numbers were awful. Some of these year-over-year declines in their revenues were really bad, but the stock is ripping higher because the market was priced for disaster. And instead of total disaster, dogs and cats living together, we just got like your basic biblical flood. And so the market is rallying on that news. Strange times we live in, folks. Why don't we shrink my big melon of a head and let's see what's going on in the markets today. Hey, everybody, don't forget that like button while we're doing that. Really helps with the YouTube algorithm. And if you're new here, hit that subscribe button as well because we do this every morning. And there's the S&P 500 up 47 points or 0.9% this morning. That big green candle right there, that was the initial and continuing jobless claims. You can see how the market is interpreting that as bullish economic data, even though it wasn't really bullish, more and more people losing their jobs, but it wasn't a disaster and the market was afraid of a disaster. So a little bit of a relief in stocks. The Dow is up 175 points or 0.45% higher. Same story as the S&P chart. Leg up right there on the jobless claims data, and we've been kind of bouncing around sideways ever since. And the NASDAQ is also leading the way higher, up 200 points for the NASDAQ, 1.16% higher, also driven by those jobless claims, which were not as bad as feared. So stocks are up pretty much across the board this morning. Let's look at commodities here. Gold and silver are liking that data that just came out. We got gold up $22.50 here, trading at $2,405, above that all-important 2,400 level. That's about 1% higher this morning. Spot silver, meanwhile, is back under $27 at $26.95. Although that's up 35 cents this morning, 1.33% higher for spot silver. We've got coppers essentially unchanged. Platinum is down a fraction of a percent. Palladium's up about 0.75%. And crude oil is up again this morning, 16 cents higher here. September WTI futures are at $75.38. That's up from a lows of about 72 and change a few days ago. So oil is staging a little bit of a relief here as those recession fears are somewhat receding ever so slightly, but still down below where it's been trading at for a while here. And let's just check in with Bitcoin. Bitcoin is also rallying on this news of the lower than expected jobless claims. And again, I use that phrase lightly. Currently up $2,829, 5% higher for Bitcoin on Coinbase this morning, trading at 57,981. Again, it's kind of behaving a little bit like a risky tech stock here, rallying on the news that the recession might be a little bit further away than some had feared. Looking over at the U.S. dollar, we got a stronger dollar this morning here, 103.37. That's up 17 basis points. Interesting to see the dollar rallying on that lower than expected jobless print. I don't think those initial and continuing claims really are going to have any impact on what the Fed does in September, but the Dixie is trading as if it will. Maybe a little bit of a yen reaction going on there. I'm not really sure. And then looking over at the bond market, we've got yields continuing to move higher this morning. Still, those yields moved. Again, higher yields, guys. The inverse relationship between prices and interest rates. As you see yields moving higher, that's prices moving lower. So bond traders are selling bonds again this morning, in particular that middle of the yield curve. The 30-year Treasury, 4.297. That's down another 3.5 points this morning. The 10-year is at 4.004. That is down 3 points and change, almost 4 points. And the 2-year, look at that, 4.061. Just a 6 or 5.5 basis point spread now between the 2 and the 10. That inversion is getting smaller by the day here. 2-year is up 6 basis points. And the 1 month is at 5.345, essentially unchanged on the day. Now, let's talk a little bit about what's going on here. Treasury yields rise after weak 10-year note and auction and heavy corporate supply. This is that disastrous auction from yesterday. U.S. Treasury yields added to their rise Wednesday after a poorly received auction of 10-year notes. Yield had risen ahead of the sale of the economic growth scare that contributed to a severe bout of risk aversion in the stock market and a rush into haven sovereign debt at the start of the week. But that has now continued to fade. They're talking about the big swing, guys, how in just a span of 3 days, we went from all-out panic on Monday morning where everybody was just stampeding into long bonds. Get out of my way. I want the 10-year. I want the 30-year. And then the auction on Wednesday, hello, is anybody there? Nobody wants to bid. Quite a swing here, guys. That's, again, volatility. Market sentiment turning on a dime just doesn't strike me as a particularly healthy market. What's happening? The yield, let's see, here we go. What's driving markets? An auction of the 10-year Treasury notes was poorly received early Wednesday afternoon, contributing to a rise in yields and appearing to take the steam out of a rally in stocks. Stocks started to sell off on that 10-year auction yesterday, and they continued through the close, although they're higher this morning. Vail Hartman, a rate strategist at BMO Capital Markets, described the sale of $42 billion in notes as weak, producing a tail of 3 basis points. Again, they had to lower the price until enough buyers appeared, and that resulted in the interest rate rising by 3 basis points before they found enough buyers. That's known as the tail. A tail is the difference between the actual yield awarded in the auction and the yield seen in pre-auction trading. A large tail can indicate weak demand. Total bids exceeded supply by a ratio of 2.32. That's known as the bid to cover ratio, but that's versus an average of 2.53 for previous auctions. So again, lower demand. Dealers took home 17.9% of the sale versus a 12% average. Again, less demand from the buyers. Yields, which move opposite to bond prices, rose in the secondary market while stocks erased earlier gains to drift into negative territory. So a little bit of a lower demand, lower appetite for bonds. And while we're talking about that, guys, let's also talk about reverse repo, because that is now starting to move around here. $286.66 billion for reverse repo yesterday. Another decline. So we're finally starting to see a move down in the reverse repo after several months of sideways trading. Remember, guys, we were seeing big drops in reverse repo all through last fall and into the beginning of winter. And then right around February, March timeframe, that started to level off, and it didn't drop really at all through all of April, May, June, and most of July. Now here we are in the beginning of August. We've seen this go from, around 400 billion now down to 286 billion after dipping below 300 for the first time. We saw another decline yesterday of about another 5 billion. Not a huge decline, but another decline. So keep an eye on this. This is starting to show, hey, maybe liquidity in the bond market starting to flash some warning signs here. And what might be driving that? Well, we saw this article in Bloomberg. Don't let the language intimidate you here, guys. They're using a lot of financial jargon here. But this just goes to show a lot of people lost a lot of money on Friday and on Monday. Fast money quants are hammered after everything went wrong because everybody in Wall Street was crowded into the same stupid trades, the short vol, the AI mania, and the yen carry trades. And they didn't realize all three of those were essentially the same bet and they all move in unison. Well, that happened all at the same time. And of course, they all lost money. Quant funds that chase the hottest trades on Wall Street are getting thrashed as momentum bets backfire all at once. Going into July, trend followers were positioned for the year's big trades to keep gathering momentum. They were plowing into stocks, betting against developed nation government bonds, and continuing on the yen to keep weakening, according to Societe Generale. Then each of those markets moved sharply in the wrong direction, hitting them with deep losses. By one broad measure of the group, nearly all of this year's gains were wiped out. Everything went wrong at the same time, said Andrew Beer, founder of Dynamic Beta Investments. This is a classic cross-asset reversal, he said. Most of the funds have given back anywhere between half to three-quarters of their gains year to date within the past few weeks. The reversal of fortune is underscoring the inherent risks in strategy that proliferated during the recent bout of market calm and likely added fuel to recent swings as investors unwound crowded trades. Guys, when everybody and their brother is in the same trade, that's when you know it's time to get out. Crowded trades, everybody stampedes for the exits at the same time, and you end up with Monday morning. Now, JP Morgan is again on their quest to reassure everybody that everything is fine and this is all behind us. I don't know where they get these numbers from, but JP Morgan says 3/4 of global carry trades are now unwound. How? Yesterday, I was reading that op-ed from Mohamed El-Arian, and we were watching the yen weaken yesterday, suggesting that people were starting to pile back into the yen carry trade, especially after that weak sauce from the Bank of Japan. And then the Department of Arbitrary Numbers at JP Morgan comes out this morning and says, don't worry, guys, 3/4 of the carry trade is now unwound. When on Tuesday, they said it was half. How? How did that carry trade get unwound on a day when the yen weakened against the dollar, JP Morgan? Are you just making these numbers up? I would really like to see the math that goes into these statistics. And we get this every time. Every time there is some crisis, by the time the financial elites, the banks, or the regulators admit the crisis is even happening, it's usually been happening for weeks. And then as soon as they admit that there's a crisis, don't worry, the crisis is over and the bottom is in. And they just say that over and over and over again until it becomes true. Where is JP Morgan getting this data from that says 3/4 of the global carry trade has unwound? Especially considering 2 days ago, they told us it was half. And if anything, people have added to carry trades since then. It just strikes me as them making up numbers as they go along here. All is well. Our banks are strong and resilient and well capitalized. Speaking of the yen carry trade, let's check in real quick with Japanese stocks. They were down again yesterday despite the green candle. They actually closed lower than the close on Wednesday. They were down about 258 points in the Nikkei 225. That's about 0.75%. All things considered, it was a pretty good day for Japanese stocks, even though they were down. Guys, look at these big red candles from the prior few days. So I'm going to go ahead and call that one a win. We had relative calm in Japan yesterday. And also looking at the yen, this is USD JPY. As this chart moves higher, that's the yen weakening. As it moves lower, it's the yen strengthening. And one of the reasons why I'm jumping down JP Morgan's throat here is because they told us on Monday that it was halfway unwound when we were here. All right. So we were halfway unwound in the yen carry trade when we were here. The yen has weakened. Again, as this moves higher, that's the yen weakening. And now we're here. And JP Morgan says now it's 3/4 unwound. So how did 1/4 of a multi-trillion-dollar yen carry trade unwind in the last 2 days? And yet the yen has weakened. The yen strengthens when the carry trade unwinds. And that's why I think JP Morgan is just blowing smoke here. I think they're just making this up as they go along to try to restore calm in markets. There is no way 3/4 of the yen carry trade has unwound over a span of 3 or 4 days. It just does not happen that fast. It took 15 freaking years to create the yen carry trade. It doesn't unwind on Monday morning. It just doesn't work that way. Anyways, the yen continuing to weaken here, 147.25 this morning. That tells me people are piling back into the yen carry trade, especially after those weak statements from the BOJ yesterday. All right, let's talk jobless claims real quick here, guys. United States initial jobless claims, the number of people claiming unemployment benefits in the U.S. fell by 17,000 to 230,000 for the period ended August 3rd. That's below market expectations of 240,000. Despite this claim, the claim count remains significantly above this year's average, indicating that although the U.S. labor market is still historically tight, no, it isn't. It has softened since its post-pandemic peak. In the meantime, the outstanding claim count increased by 6,000 to 1.875 million. So here is the initial jobless claims data. You can see, guys, we got a big step down from last week. I think that's probably why the market was rallying on that news. Last week's number, that 250,000, by the way, that was revised upward from 249,000. Last week's number really spooked markets, especially because that came in just a day before the non-farm payrolls. That was terrible. The jobs report on Friday was awful. The unemployment rose to 4.3% unexpectedly. Well, we got a little bit of a sigh of relief here. Those 230,000 initial jobless claims, although that's higher than what we got for most of the last year, it is down substantially from last week's number. Continuing claims, however, not so good. Continuing jobless claims in the United States increased to 1,875,000 in the week ended July 27th. That's up from 1,869,000 in the previous week. Continuing jobless claims in the U.S. averaged this, from the last 40 years. So here's the deal. Continuing claims, this number continues to rise here. That shows that people are still piling up in the unemployment rolls, that the number continues to rise. Now, here's one thing that's probably not getting mentioned a lot is that last week's number was revised lower. This 1.869 million number, that was 1.877 last week. So they revised last week's number down by a pretty good clip, by about 7,000 or 8,000. And if you consider where we're at now, the number we just got this morning is actually slightly lower than the old number from last week. So if you just take a snapshot of where we were yesterday and where we are today, continuing jobless claims in the U.S. actually came down. You can see that if you scroll down here. You can see last week they reported the actual number as 1,877,000. And then this morning, they're reporting the previous number as 1,869,000. So you had an 8,000 downward revision to last week. So the only reason this trend is still rising is because of the downward revision. So again, I think that's probably why the market is breathing a sigh of relief here this morning. These numbers are not good, but they're also not a disaster. Excuse me a second, guys. Still clearing my throat. Now, restaurant data. Yesterday, we had a lot of terrible data about restaurants. This morning, we have some just or plain old bad data. It's not terrible, but it's not good either. Restaurant Brands revenue tops estimates fueled by Tim Hortons. Restaurant Brands International on Thursday reported quarterly revenue that beat analysts' expectations, fueled by better than expected sales at Tim Hortons and the company's international restaurants. Shares of Restaurant Brands fell less than 1% in pre-market trading, though. The company reported 86 cents a share adjusted versus 87 cents expected, so a little bit of a miss on the earnings. Revenue, however, came in at $2.08 billion versus $2.02 billion, so we got a beat on the revenue line. Restaurant Brands reported second quarter net income of $399 million. That's up from $351 million a year earlier. Net sales rose 17%, boosted by recent acquisitions of Burger King restaurants in the U.S., so they bought new restaurants, so it's not really a comparable number. But the company's same-store sales increased 1.9%. All right, so you do have a same-store sales increase, but remember, that's not adjusted for inflation. If you factor in inflation of roughly 3%, well, then you actually have, on a volume basis, you got real sales are falling. But still, it could have been a lot worse. Dine Brands yesterday was reporting much worse numbers than this. One of Restaurant Brands' four chains, Tim Hortons, performed the best with same-store sales growth of 4.6%. Popeye's same-store sales rose 0.5%. Burger King and Firehouse Subs reported same-store sales declines of 0.1%. People still not really getting that fast food. Restaurant Brands International locations saw same-store sales growth of 2.6. So all of these numbers, all these same-store sales numbers are either negative, like Burger King and I forget what the other one was, but the other ones are positive but below the rate of inflation. So either way, these are not really good numbers. They're just not disastrous numbers. Restaurant Brands stock right now is down 2.15% ahead of the opening bell, trading at $69. That's down from $70.52 yesterday. Also on the restaurant front, guys, we got this one in Bloomberg yesterday. And again, I put this out on Twitter yesterday. It's time to tune out the academics and these gaslighting political hacks who are denying that we're in a recession, saying, oh, everybody's better off than they were a few years ago. No freaking way. Headlines like this and stories like this do not happen during periods of prosperity. Richer Americans are turning to IHOP and Applebee's for cheap eats. All right. Who had Mr. Howell eating at IHOP on their 2020s bingo card? Rich people aren't supposed to eat at IHOP. All right. They don't care about discounts on pancakes. They're freaking rich. They're supposed to be rich. All right. And if the rich people are eating at IHOP, what are the poor people doing? Well, let's read on and they'll tell us. Wealthier Americans are visiting IHOP and Applebee's more often, and they're looking for deals on their pancakes and wings. Dine Brands Global, the two chains' parent company, has experienced a drop in visits from lower-income customers in recent quarters, but at the same time, it's attracting more guests from households that make $100,000 and up, CEO John Payton said in an interview on Wednesday. All diners, regardless of how much they make, are gravitating to value offerings, he said. New deals, including unlimited riblets at Applebee's and breakfast combos at IHOP's, are doing well. Some higher-earning guests are finding us as they also think about managing their wallet. The trend at Dine underscores how stretched Americans' budgets have become after years of elevated prices. The company's lower-income consumers aren't trading down to cheaper restaurants, he said, but rather they're eating at home to save money. And remember, articles like this, the next time one of these academics says, soft landing achieved, victory over inflation, because the academics just look at the rate of change. They don't look at the cumulative pain that has been felt by the average consumer. The average consumer doesn't care if the rate of change is moving sustainably towards our arbitrary 2% target at the Federal Reserve. The average American cares that the prices went way up and they're still way up and they're still rising. I don't care how fast they're rising. They're still freaking rising. And I can't afford to eat there anymore. So now you got the rich people are going to IHOP and the people that used to eat at IHOP are staying home. That is not a strong economy. That is not people who are better off. That is the cumulative pain of inflation being felt by the average person. It's time to tune out these academics and these gaslighting quacks who keep telling us things are so good. Also going on this morning, Under Armour posts a surprise profit on lower inventory amid a turnaround push. This is being interpreted as good news, but the numbers look pretty terrible to me from Under Armour here. Under Armour posted a surprise first quarter profit on Thursday, benefiting from its efforts to reduce inventory amid a challenging wholesale business and softer demand for its athletic wear in North America. Again, they're saying this is good news, soft demand, reduced inventory. This doesn't sound like great news to me. Inventory dropped 15% to $1.1 billion, and the company raised its annual profit forecast, sending its shares up nearly 8% before the bell. Under Armour is attempting to reset its business by reducing the pace of promotions, cleaning up its inventory, limiting online discounts, and focusing more on profitable items such as men's apparel. Despite its efforts, quarterly revenue from its biggest North America market declined 14% as persistent inflation stretched customer budgets, while revenue from international businesses fell 2%. Once again, guys, tune out the academics who tell you everything is so good. Here is an apparel maker telling you our revenue in North America is down 14% year over year because customer budgets are stretched. That is not a good thing. Softer demand, meanwhile, has led wholesale retailers to reduce orders, resulting in an 8% fall in Under Armour's wholesale revenue. Its first quarter revenue dropped 10% to $1.18 billion, smaller than the nearly 13% decline analysts had anticipated. And I think that's why the stock is doing pretty well here, guys. They're saying, again, all terrible numbers. First quarter revenue dropped 10%, but they were expecting a drop of 13%. So it's a bad number, but it's not nearly as bad as we had feared. And so Under Armour stock looks pretty good here. Look at this thing, up 13% on a 14% decline on North American revenue, a 10% decline in sales in Under Armour in America, and the stock rallies 14%. That just goes to show you how low expectations were. But again, I want to temper that enthusiasm, guys. Year to date, this stock is still way down, well off its highs. But Under Armour having a pretty good morning this morning. And guys, that is about all I got for you here. But I do have to say thank you so much to Mr. Evan Francis. Evan says, I'm expecting a bounce soon, maybe the SPY off to 200. S the B's in one last time. Also keep an eye on credit spreads. Fred hasn't updated yet. You know, credit spreads blew out last week. That's a good point, Evan. The difference, or the higher interest rate people are demanding for riskier debt. For a while there, up until about last week, it was very low as Japanese banks and people who were chasing yield started piling into risky debt, driving up the price of that debt and driving down the yield on it. So the spreads were narrowing. Well, that blew out. That reversed very abruptly last week, and the spread started to widen pretty substantially. We haven't seen an updated data point yet, but we'll see. That's going to be an indicator of how much liquidity stress might be breaking up. When you see yield spreads start to blow out, that's usually a sign liquidity is getting tighter. And what we saw in the 10-year auction yesterday and that reverse repo falling, that is suggesting a little bit that liquidity is starting to tighten up. We're still a long way away from a outright liquidity crisis, but we could get there in relatively short order. Thank you very much, Mr. Francis. Appreciate the super chat and the support of the channel. And thank you to my buddy Cole, who says, my 2 cents is now tree fitty. I need about tree fitty. Is that what you're saying there, Cole Marsh? Thank you, sir, for your hyperinflated 2 cents now becoming $3.50. We're going to put it right in the coffee cup this morning, sir. I appreciate the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melon Heads once again this morning. I appreciate that very much, guys. We will be back tomorrow at the same time, 9 o'clock a.m. So thank you so much to my channel members, my magnanimous Melon Heads on YouTube and Patreon for supporting the channel. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.